Well, thank you everybody for joining us here at Cummings for our podcast on the AIFMD. I'm Claire Cummings and I'm joined by my colleague John Langan.
Hello everyone.
What we'd like to do today is talk about the AIFMD, but also more importantly give you an idea of the questions you need to be asking and what the possible answers might be, so that together we can work towards finding a way of becoming fully compliant with the AIFMD. Perhaps the first point to make is just one on terminology. Rather than going through the long-winded AIFM and AIF, we're just going to talk about managers and funds and assume that they are AIF managers and AI funds. We're also joined today by Stuart Kershaw, who will be moderating the podcast.
Thank you, Claire. Could you possibly go through a checklist of the sort of questions that managers need to ask?
Of course. Well, John, I would say the first two questions, the critical ones, are you a manager and are you managing a fund?
Yes, absolutely. And the directive is very broadly worded, so pretty well everything that you think is likely to be a fund will end up being a fund unless it's a UCITS type fund.
And the distinction really is your fund going to be EU domiciled or is it non-EU?
Indeed, although if you are a manager within the EU and you're managing a fund, then it actually doesn't matter where your fund is or how it's structured.
It still has to comply.
Indeed.
Yep. The difference really comes in the marketing of that fund, not
Yes.
not the day-to-day running of it to comply with the directive.
That's right.
Yeah. What about the definition of a manager? I mean, again, that's very broad.
It is quite broad. The directive is quite helpful in that it says that if you're a manager, then at the minimum, you should be providing portfolio management and risk management services to the fund. Those are the two crucial things. It then lists a whole series of other things which have more to do with the administration of a fund, which the manager can, in addition, provide. But the essential things really are the management of the portfolio and the management of risk.
Yep. And while the portfolio management can be delegated, the risk management needs to stay with the fund manager. And there's also the concept of letterbox, which again is slightly broad. The manager has to retain a material amount of activity, at least in the risk management area, and can't be what the legislation refers to, albeit rather broadly, as a letterbox.
Yes, that's right. The manager needs to retain the sort of key decision-making powers that a manager is expected to have, and the ability also, at the very least, to supervise the management of the portfolio and to manage the risk element.
I think it's unlikely that many of the people who are listening here today will have a problem with the letterbox issue. I imagine that most people will be MiFID firms and they will choose somehow to separate, as required in a hierarchical fashion, the risk management from the portfolio management. John, we've already talked about a number of ways that managers can do that. The letterbox issue is more likely to apply to platforms, but then again, we've been talking internally and we think there are some reasonably neat solutions to this that listeners are always very welcome to come and talk to us about.
Yes, indeed. There are ways and means of making sure you preserve enough of the functions that a manager is expected to have in order not to breach the requirements of the directive.
And on the sort of the hierarchical segregation of risk management and portfolio management, the two solutions that we've been talking about here are probably, I think, which might be the most common, is that there is a risk management function within the MiFID firm and a portfolio management function. The two are separate, and there is a complete sort of Chinese wall between the two, and there is what you might term as a higher band of management that oversees the both and is able to step in if there are any issues between the two.
Yes.
The other way we talked about was firms may want to set up a separate company or partnership to provide the portfolio management and retain risk management.
Yes, that might be suitable for larger investment management groups where there are a variety of different entities, some providing general oversight and others providing investment management possibly to a range of different sort of entities and clients. I think in most corporations, most companies, you're always going to have the directors as the top layer of management overseeing the whole, and then beneath that layer you'll have this division of functions into portfolio management people and risk management people who need to be kept separate, and other functions which the directive also requires relating to internal audit and of course compliance.
Yes, yeah. If people do decide to go down the separate company route that we talked about, that does bring us round to the question of delegation. There are two things there. One is that many structures already have in place a form of delegation within their structure, so their delegation agreements needs to be looked at. Alternatively, if a separate outfit were to be created to perform the portfolio management, again, the delegation agreement put in place would have to be very carefully drafted, wouldn't it? Because the legislation is quite particular.
Yes. I think most delegation agreements do tend to contain the sort of quite useful provisions about the delegatee being subject to the overall supervision of the entity and its board of directors who are who are delegating the activities. And also, I think what you need to be aware of is that the directive and the new regulations between them effectively prohibit managers from absolving themselves of liability or obligations by delegating. So the manager really has to be where the buck stops.
Yeah. And the other thing as well is that the manager has to know that the person it's delegating to is fully capable of carrying out the business that's delegated. But actually, I think that's more sort of a practical commercial point. You don't really need to put into legislation that you don't appoint people to be fund managers unless they can be fund managers.
Indeed. One thing to watch for is that if you're delegating portfolio management functions, then there are restrictions on people delegating them outside the European Union or other countries which are called third countries, which have cooperation agreements with the European Union and therefore are sort of deemed to have, as it were, equivalent legislation in place.
Yeah, and some countries have already entered into those cooperations.
Indeed.
Switzerland and Ireland, for example, are two which have.
Yeah.
Claire and John, does this apply to the very small managers?
Interestingly, it doesn't. There is a de minimis rule, one for a non-leveraged fund, one for leveraged. And John, for hedge funds which are leveraged, the de minimis limit is 100 million.
Yeah.
For funds which aren't leveraged and which also have reduced liquidity, the threshold, the de minimis threshold is 500 million.
Indeed. In crude terms, that equals effectively a division between hedge funds on the one hand and
Private equity
funds
on
like private equity,
Yeah.
property funds, art funds, and all the rest on the other hand.
Yeah, the funds which the Commissioner would see as less dangerous because there's less borrowing, and also probably there's going to be less liquidity in the market for those assets.
Indeed. I think it's worth bearing in mind here that you don't get out of it completely freely just because you're below the levels of the de minimis levels, because even managers below those thresholds still have to register with the competent authorities, which means the FSA at the moment in the UK, or the FCA as it will eventually change into.
It will become in April.
Yes.
And you still have to maintain the whole time consideration of whether you're going to go above those de minimis levels, because then you will have to go into the fully fledged regime.
Yes, so one of the first things for for any manager really to do is to value the assets and see whether, in accordance with the directive, and see whether the manager is subject to the directive fully and above the de minimis thresholds, whichever is the one that applies, or whether the manager is caught only by the obligation to register itself and identify its funds to the FSA, and also give detail to the FSA of its investment strategies and its major concentrations of investment.
So the smaller funds which are below 100 have to be very careful that actually, if they are successful, they may tip themselves into what might be regarded as a rather punitive regulatory regime because they have been successful. And we're still waiting for the FSA, which will become the FCA in April, to bring out the forms, publish the forms.
Indeed, and we don't yet know either what sort of approach they're going to take as regards the so-called regulation light, and whether, as the directive does entitle the member states to do, whether they might impose some greater requirements on those managers who are subject only to the basic registration requirement rather than the full authorisation requirements and full compliance with the directive.
Claire, John, if I was a manager affected by this legislation, what would I need to do?
Well, the first thing I think is to look at the separation of risk management and portfolio management that we've discussed. The second thing would be to review your administration and prime brokerage documentation. The administrators and prime brokers have been talking to each other for a while now to work out how they together can provide the requirements of a depository which are set out in the directive. Obviously, if there are going to be major changes there and the fund is listed, you also need to liaise with listing sponsors. John, is it worth maybe talking about the depository requirements set out in the legislation, in particular the liability which is going to be expected to be taken on by the depositories?
Yes, this is more of a concern, I suppose, ultimately for the depositories themselves, because the directive does impose a greater degree of liability on them for loss of investments and so forth, and responsibility for the actions of sub-custodians than perhaps depositories and certainly prime brokers have been used to accepting in the past.
And the question is also the issue of who has control of the assets, and trying to reconcile the depository requirements within the legislation to the fact that the assets are held by the prime broker or clearing broker.
Yes, and the regulations give different alternative structures here for the structuring of depository arrangements. And the depository idea really has been read across straight from the UCITS legislation. And prime brokers in the hedge fund sphere are not used to the concept of being in any kind of a supervisory position or a position where they're responsible for loss, responsible for custody and so forth.
And it's worth just pointing out for clarity that these depository requirements apply to the fund whether or not it's in the EU, if the manager is in the EU.
Yes, that's right.
If there's a non-EU fund and a non-EU manager,
there's a limited
carve-out.
carve-out for them, yes. Yeah. But broadly what the regulations say is that if you have the typical hedge fund structure where there are collateralized assets, that either the prime broker needs to be itself the depository or the depository needs to appoint a sub-custodian to hold the collateralized assets on behalf of the prime broker, or the depository needs to earmark the collateralized assets for the prime broker.
Yes, and perhaps it's also worth just touching on some of the other duties of the depository, which include monitoring cash flows, considering the scope of the assets held in custody, looking at the reporting obligations of the prime brokers or the clearing brokers, and then those which the administrator currently undertakes of looking at subscriptions and redemptions and valuation of assets, but of course they need to be done in accordance with the legislation as well.
Indeed, and that will lead to quite a few changes in the documentation of funds and possibly also in the structural arrangements with the introduction of new parties. For instance, most hedge funds will not have had anything akin to a depository in the structure at all, whether the prime broker or not. So there may be, with some funds, a need to do some contractual restructuring as well as tinkering with the actual documentation reflecting the depository and prime brokerage arrangements.
Which will knock on to, as we were saying before, listing announcements possibly if the fund is listed.
If it is listed, yes.
And an update of the offering memorandum, which will be fairly comprehensive. And then the offering memorandum itself will have to be filed in the relevant area, sent to investors. John, bearing in mind the fairly fundamental changes which will come into force with the depository, prime or clearing broker arrangements, do you think that funds are going to be required to seek investor consent for these changes and give investors the right to redeem if they don't want to stay within the fund being restructured like this?
I think it will depend on what the documentation and terms of the fund says in any given case. Normally, fund documentation will have buried in it somewhere a clause that says that you don't have to go and get investor consent if you're just making changes to reflect changes in legislation and regulation.
And that would be backed up within the constitutional documents
Indeed.
of the fund as well?
Yeah. Yes. So you wouldn't expect there to be any such change that required investor consent.
That said, while it's not an issue of consent, it would be very surprising if managers didn't send out, possibly in their monthly reports, details to their investors of how the AIFMD is going to impact them.
That takes us nicely into the reporting requirements. What are they?
Well, again, these are set down in the legislation. There's a regulation light reporting regime, and then there's the fully fledged manager reporting. There are some very useful tables within the legislation which give you guidance on this. And certainly we at Cummings are able to provide draft reporting documentation for clients and work with them and ensure that reporting to clients is carried out in accordance with the legislation.
Indeed, there are several different levels here because there are requirements for what you have to put into the annual report and accounts. There are requirements for what you have to put into periodic reporting to investors, and also the sort of things you need to be telling the regulators. And in addition to that, specific disclosure requirements as regards the risk profile of the fund, the liquidity profile, and any special arrangements in relation to liquidity, such as, for instance, gating provisions or side pocket arrangements. And frankly, a lot of that you would expect to see in a properly written
a lot of it's
offering
going to be
memorandum
the offering.
So there won't necessarily be a huge amount of difference, but you are meant to notify, for instance, changes in certain things over the previous year in your account and reports, and changes in maximum leverage levels and all that sort of thing.
Yeah. And then for the regulation light, as we were saying, those managers who fall under the de minimis rule will still have to make certain reports, but that's to the regulator, not to their clients.
Yes, it is to the regulator. Again, those sort of managers, if they're operating under quite sort of thorough and rigorous documentation, will probably have done a lot of that anyway. But things such as, for instance, the requirement for those smaller managers to notify the regulators of their investment policies, the major markets they operate in, and the major concentrations of investments they have, really are quite new. Those managers haven't been under those sort of reporting obligations before. So
I suppose the rules on investment techniques are new as well, aren't they?
Yes, indeed, and some of the requirements that will probably impact more on private equity managers, rules against asset stripping and notifications of taking control over private companies and so forth. Those are quite new as well for those sort of managers.
I think there are certain points which require reporting, which managers may be able to deal with in their monthly reports to shareholders, possibly marketing materials and websites. And that does sort of, I suppose, bring our checklist on to saying that all marketing materials, websites and everything needs to be looked at and will need to be updated. And I think also the disclaimers will need to be looked at.
One of the major themes within the legislation is the topic of passporting, and I wondered if you could talk to us a little bit about that.
Yes, of course. But I think As we said at the beginning, the first thing you need to think about is what your status is. So there is a combination of EU managers, non-EU managers, EU funds, non-EU funds. John, I imagine most of our listeners are going to be EU managers who will either have EU funds or non-EU funds. And I think perhaps if we tackle the EU manager, EU fund, first of all, the manager will need to notify the competent authorities in its own state, and that will be part of the FSA process. It also needs to notify other states in which it will market, and again that's done through the FSA, and people who are already authorised by the FSA will probably be aware of the passporting form, and I imagine that something similar to that will be provided, and then the home regulator will liaise with the various host regulators. Then, as you'd expect, the manager has to comply with the directive as a whole, and as is currently the case, also has to apply with the marketing laws and the conduct of business laws in the host states, while still remaining authorised in the home state. And then the passporting rights can be made use of from the 22nd of July onwards.
That's right. That's on the basis of a European Union authorised manager promoting a European Union-based fund.
And where it's an EU manager with a non-EU fund, it's slightly different, isn't it?
Yes.
The manager will still have to be AIF compliant.
Yes.
Because it's caught by the directive.
Yeah.
But the marketing is slightly different.
It is. There won't be a passport for non-EU funds until 2015, when it's anticipated that the benefit of the passporting rights will be extended to those non-EU funds which are compliant.
If the Commission decides to do so.
It
may
indeed.
not switch on, but it's probably likely it will.
That's right. Until then, and indeed beyond that date, up until 2018, any manager looking to promote a non-EU fund will need to rely on the existing private placement rules as they apply in different countries which happen to have those rules. So, for instance, in the United Kingdom, the existing rules that enable authorised persons to promote unregulated funds to people will continue to apply, with a few additional requirements imposed by the directive. For instance, the fund must be based in a country that has a cooperation agreement with the supervisory authorities of or with the FSA, if you're talking about the UK.
And the country must also be cooperative.
Indeed.
FATFA
reasons. Yes, that's right. And those sort of requirements run through the various permutations of what funds you can and can't market into the European Union, whether you're a European Union-based manager or a third country-based manager.
So, for example, if you have a Cayman Fund, BVI Fund, Bermuda Fund, for example,
yes,
Channel Islands, Isle of Man, all those funds you can market in.
Yes.
Because they meet the criteria of the
indeed.
fund's home being acceptable under the legislation.
As long as those countries, or whichever one you choose, has a cooperation agreement in place with the FSA.
And I believe all those countries are working towards that at the moment.
They are indeed.
Yep.
Yes.
And they will be then in the same position as, for example, Ireland.
Yes.
There are also a number of non-EU funds which are marketed in the UK which do not have EU managers. They may, for example, have managers in Cayman or Bermuda, and also US fund groups which are managed from the US. Now, they can also make use of the private placement rules we've talked about, and again, they must have in place cooperation agreements, and the FATFA cooperation must be in place.
Yeah.
There are also reporting requirements, though, aren't there?
Indeed, those managers will be caught, but then again, they're not totally outside the scope of the directive, in the sense that they will be caught by the various transparency and reporting and notification requirements in the same way as a manager that is authorised and resident within the European Union.
So again, as we're saying, there are some useful bits of the legislation that give guidance, and we at Cummings also have our own forms that we can help clients complete for that. And the reporting could be done via the monthly report, via marketing materials, and a number of other ways. Well, thank you very much, everybody, for listening to us. I hope that you found it very useful. We'll be putting on our website a longer article on AIFMD and how to comply. If you have any questions, again, our details are all on the website, cummingslaw.com. We look forward to hearing from you. Goodbye.
Bye-bye.